Joining us right now, first on CNBC, is Peloton CEO John Foley. And we should also say that Comcast, parent company of this network, is an investor in your company as well. I want to make that clear. Thank you for coming on.
Thank you for having me.
On this important day in your journey. Were you surprised, maybe you weren't, that you were actually able to price at the top end of this range, given all of the questions that seem to be surrounding the IPO market right now?
Yeah, it was a thing. You know, we were following it like everybody else. There was a ton of demand. I just obviously got off the road for the last 2 weeks. Got in front of a bunch of investors. Fun process, learning. It's my first IPO, but I think the demand was there. High quality investors, and so we were able to price at the top of the range. We're excited.
What has been the lesson, though, as you've traveled the country over the last 2 weeks, also amid swirling questions about WeWork, which of course has been in the headlines, where Uber and Lyft and so many others have priced?
Yeah, as a business person, I'm fascinated. I read and follow the stories like you do. Today, obviously, we're celebrating Peloton's IPO, right. And so we're excited about this moment on the Peloton journey. We think we've built an incredible company. The foundation is great, the economics are great, the business model is great, the team's great. So we feel like we are special in this.
Your first IPO, I love that.
Right.
Your first IPO,
I've been saying our CFO Jill Woodworth, who I've been on the road with for 2 weeks, has taken 26 companies public.
Whoa!
So I'm a noob, as my son would say.
But the reason I mentioned Uber and Lyft and so many others is because one of the things that is interesting about this particular vintage of IPOs is you have fast-growing companies like Peloton. This is a company now that has revenue nearly $1 billion. But also losses. That's right. Meaningful losses. In your case, they've increased over time as the revenues have gone up at the same time, $195 million in losses. And so there's a question about the path to profitability and how investors think about that.
Sure. So let's reframe. Let's use the semantics here. I call them investments.
Okay.
We are investing, and we're in investment mode, and we are prioritizing growth over profitability right now. So we are investing in the new category of the treadmill, Joe, to your point. We are investing in Europe, so we are in the UK still in 1 year in, and we're investing in Germany. We go to Germany in the next 60 days with 6 stores in the 6 major metropolitan areas of Germany. We're hiring the instructors, we're opening the stores, we're doing the logistics. All of that is obviously expenses out in front of the revenue, so we call it investment stage, and we think it's disciplined investing.
In terms of, though, how much of those are one-time capital costs, meaning the development of studios and new technology, and other costs, which I imagine are obviously ongoing, stores, new instructors, employees.
Yeah, so think about, it's both, some OpEx, some CapEx, but here in New York City, we're building a $50 million television production studio just down the street where we're going to have 4 studios under one roof. The best yoga, the best boot camp, the best cycling, and a 4th studio to future-proof it if we come out with other products in other categories. We're also doing a $50 million studio in London. Similar story. Our German instructors are going to coach out of that studio. And so do you think about the fixed cost leverage in our subscription business over time that would go north of 70% gross margin on that because of the fixed cost leverage, over 1,000 basis points of margin expansion because of the leverage.
So those are one-time costs. That's $100 million alone right there. Right. In what year do you expect to be profitable?
I think we're showing 2023, fiscal 2023 in the 5-year plan.